Hi guys, welcome back to the channel. My name is Dave, and year to date, the S&P 500 is up 16.5% here in 2025 as we head into December. Looks like it's going to be another outstanding year for us. Great. However, there are a lot of concerned investors that are reaching out to me asking, like, is it the end of the bull run, right? I think they've been watching too many of the frowny face videos, hands to the face, right? End of days, it's coming. I know it. I can feel it. Well, I know it sometimes feels that way, and my candid advice tends to be stay invested, have a plan, time in the market beats timing the market. You've heard it all before. But I get it. So if you are in that camp and you're really concerned and you want to take some action here towards the end of the year, what are some things that we can do? So I've got some different ideas, and I'm going to share them with you right now. If that is what you're looking for, please stick around. Whoop. So let's flash back to February 19th of this year. We hit an all-time high in the S&P 500 at 6150. By April 8th, we had dropped to 4980, right? Down 19% from our all-time highs. Now we recovered by June 26th, so it didn't take long for us to climb out of that gutter and recover everything that we had lost if we just stayed invested. So again, I want to come back to that point. It's really important. Now, as we come to the end of the year here in 2025, people start looking at their portfolio. They start thinking about diversification. They start thinking about rebalancing, maybe tax loss harvesting in a year where most stocks are up. There's still some opportunity sometimes out there to tax loss harvest as well. So with all these things in mind, if you are feeling bearish, what are some things we can do? So number one, and probably the most obvious, is to sell some, right? Take the gain off the table, book the win, nobody will fault you. And this might already be part of your rebalancing efforts here for 2025, depending on how you have your portfolio structured. So as of today, the S&P 500, again, up 16.6% year to date. So if you had a $500,000 portfolio just in the S&P 500, you've got an $83,000 gain. Congratulations, good job. So sell some and move into a short duration instrument. It could be a money market account, really simple. You can do T-bills, really simple. You could do something like VTES, which is muni bonds, short duration. You could go to a little longer duration. I use IGIB. That's my 5 to 10 year investment grade bond fund I use. A little bit more duration exposure, a little bit higher yield. Just depends on how you feel about all this, but it will raise your dry powder. So if you are correct about the market falling apart, you'll have that available for you. And if this helps you sleep at night, great. Sleep better at night. And if your gain is in a taxable account and you don't want to face the tax monster, so you're hesitant to sell, one of the reasons to love the ETF wrapper is for that protection against capital gains tax. So sometimes it just boils down to finding the right product for you. For example, if you want to maintain that 80-20 balance, you might look at something like AOA from BlackRock. Just one example, but this is an 80-20 portfolio. So in years like this where equities have really performed well, twice a year it's going to rebalance. It's going to sell some of those gains in those equities, and it's going to maintain that balance in your bond portfolio. So this way you don't have the tax responsibilities because it's within the ETF wrapper. So you're not going to receive that income and have to pay the tax and then reinvest back into bonds. So again, it comes down to finding the right product for you. Number two is to hedge with options. So if you want to express your view by using options, you can buy broad-based S&P 500 put options and fully protect your portfolio. If your portfolio is $68,000 value, you could go buy this one that I'm going to put up here right now for about $2,100. You get full protection all the way out to March 31st of 2026. So that is an option. My suggestion, if you decide to use options like this, is you try not to be reactive to the market. We tend to get scared, then buy the put option. This is something that you should be doing when everybody else is sitting around saying, isn't the market amazing? I can't believe how awesome this is. So I'll put up a chart right now of the VIX. If you look at the VIX, just round numbers here. 70% of the time we're sitting in a lull. We're not going anywhere. We're sitting around. 10% we get overstimulated and we see expansion, right? And often it's really quick expansion when people start to panic, right? And this is our measure of volatility within the S&P 500 from people buying put options just like this. Then there's this 20% contraction period where things are just kind of settling back down. So when everyone else is talking about how awesome the market is doing, it's going to be inexpensive to buy put options on the S&P 500. When people start getting really excited and there's this period of expansion, it's going to cost you a lot more to start protecting your portfolio. Now you can buy simple put options like this. You can layer them in over time. You could also use index options on the S&P 500 or the NASDAQ. This is just one example, but if the VIX spikes, they will likely become profitable. If it remains in that lull period, like it does about 70% of the time, the value will slowly erode. And that is the cost that we have of having that fear of a decline and wanting to protect our portfolio with put options. So, as mentioned earlier, sometimes the best solution is just to use that same money to continue to invest, dollar cost average. Now, just to expand on this idea of using options, you could also use an option collar strategy, for example, and fund some of the expense of the put options by adding out of the money call options. That will help to offset some of the expense of this insurance, but it might also cap your upside if the stock market rallies. So, in the second example, with a short call option leg added, the cost per contract is no longer $2,100, but instead around $1,100, since we give up the upside beyond the sold strike of $720, which is about 5.4% above the current price. Also, if this is confusing, I won't leave you hanging, and you want more information about using options this way, I have several introductory videos to help you get started, and I will link one above and below that covers all these basics. And since we're talking about options, now is a good time to introduce today's sponsor, which is public.com, and talk about option rebates. So, why pay transaction fees when instead you could be receiving a credit? Public.com is a U.S. modern brokerage that offers investors access to stocks, options, crypto, and bonds, along with features like AI-powered insights. One of the features that I appreciate as an investor who trades lots of option contracts is that Public shares a portion of their options revenue with me through rebates on stock and ETF contracts. These rebates help me reduce the cost of my eligible option trades over time. Rebates currently range from 6 cents to 18 cents, and it might not sound like a lot, but it adds up quickly, especially with complex trades. And I should know, already in 2025, I've traded over 2,000 contracts. Instead of that costing me hundreds of dollars in fees, with Public, it would have potentially put hundreds back in my pocket. Now, I only recently started making option trades with Public, but so far, I've found the option platform to be simple to navigate and intuitive to use. However, it should be said that trading options carries substantial risk, and options are not suitable for all investors. Also, Public has lots of great option content to help better understand specific trades for those looking to learn more about how they might utilize options in their own routine trading. So if you are still trying to understand the Greeks, option assignment, or what might happen with your option at expiration, Public has content to help you better understand this material. So consider options trading on Public and explore how rebates can impact your trading costs. Number 3 is to invest into products that offer that built-in protection that you're looking for. Maybe some buffered ETFs or some hedged equity products. So this past year, I reviewed QQQH from Neos, for example, and it's done well this year, but the protection that it offers, it does come with a price in years like this where we have this nice bull run. You're probably going to see some underperformance with that type of product because of the cost of that protection. But you also see that if you go back to that February time period, that it does offer some protection versus the underlying by just holding QQQ. So if you have that mindset that you're willing to give up some of that upside for some protection, that might be an option. You can also look at products like those from Calamos. They have some interesting structured products for those that want less risk. So I've reviewed these products as well. I'll link that video up above because there are some important points to understand before you invest in these types of products. So go check out that video for more info or check out the website and read through the prospectus. Number 4, you can use inverse ETFs. So if you really don't want to mess with options, I get it. You can also use inverse ETFs in a similar fashion. You can express a point of view over a short-term period of time with these products. Now, I don't think you should use them for the long term. Again, we tend to go up and to the right over a long period of time. So this is a bet against the market. You might look at it over the short term. Now, some popular inverse ETFs are SQQQ from ProShares. This is their ultra short QQQ ETF. And SH is also from ProShares. This is their short S&P 500 ETF. There are also a bunch of specific sector inverse ETFs like SOXS. So I've got a bunch of exposure to SMH, or maybe you just have a bunch of exposure to semiconductors in general. You can bet against that position with something like SOXS. So they're out there. You just got to go find these things if you really want to utilize some. Now, this SH chart versus the S&P 500 illustrates how these work, right? It looks just like a reflection off the water. So if you want to bet against the S&P 500, this is a fairly good ETF for that, again, over a short period of time. Now, I recently discussed leveraged ETFs and their associated risks. We have some of the same issues here with an inverse leveraged ETF like SQQQ, which has 3x leverage. So make sure you understand those risks before you start any type of investment in these types of products. And number 5, we'll just touch on this one briefly, is you could short the market. Now, I would say this one should largely be ignored by most investors, but yeah, you certainly could go that route. So an example might be if you are an investor, you like individual stocks, maybe you have 25 positions, you highly covet these positions, you want to maintain that portfolio, but you have a negative view of the market, you might go short the S&P 500 and bet against it. You could certainly go that route. Now, I've done a video before on covered puts. I would suggest anytime you go into a short position, you consider the covered put strategy. Again, we're combining options here with a short position. I've done a video, I'll link that up above. You can check that out. But shorting the market isn't for anyone, especially with individual stocks. I feel more comfortable doing it with the broad market, but you're still exposing yourself to some risks, and you want to have the understanding of how it all works. So that's your warning. But any questions on that, just ask down below. So I totally get stock market fear, but in general, the best thing to do is to stay invested, continue to dollar cost average into great products, and over the long term, it should pay off for you. And if you have a long time horizon, a lot of this can just be ignored. You want those declines so you can buy at those lower prices. It's great, right? So have no fear if you are young. When you are older, you feel like you want to put some of these hedges in place at certain times, and that fear creeps in. But don't let it get the best of you. Now, if you have any questions on any of this, please ask down below. Like and subscribe if you like this type of content. And have a great Thanksgiving weekend. We'll see you real soon. Take care. Whoop.